Should you buy Bitcoin right now, or should you wait for it to drop a little bit more? In this video, I'm going to show you how to figure out the answer to that question, so stay tuned. All right, welcome back. So the question that I get asked constantly, both in person and online, is should I buy Bitcoin right now or should I wait? I heard it's going to drop a little bit more. I made a video a while back talking about why now is the best time to buy Bitcoin, and it's done amazing. The price has gone up huge since I put that video out, and so people want to ask me, is it still time? My friends ask me all the time. And it's not quite the easiest answer because it depends. And I'm going to show you what I mean by that. So let's see. So the first thing that people are trying to really get to when they ask me that question, should I buy Bitcoin now, right? As soon as the price starts shooting up, everybody's interested. Now, Bitcoin had fallen, but now that it's going back up, everybody wants to know if they should buy. And really when they ask me, should I buy now or should I wait for the price to drop again? I heard it's dropping. Well, what they're really trying to do is time the market. They want to time the market. They want to try and get the perfect entry so they can get the maximum amount of value. The thing is that it's impossible for most people. Most people cannot do this. They can't time the market and they end up actually losing money. Not just losing money, but probably losing sleep as well. Kind of like this image I have up right here. It's like, you know, you buy it and then you're watching and you're waiting for the price. I heard it's going to drop and I'm just waiting. And the fact is, if you're trying to time the market, most likely you're going to get it wrong and you're going to be super stressed out about it. Now let's see what some of the best investors in the world have to say about that. So Warren Buffett, of course, the Oracle of Omaha, you know, I love to quote him. He says that stock market forecasts exist just to make fortune tellers look good. I got to laugh when I say that. Stock market forecasts exist to make fortune tellers look good. That's what he says. We have Peter Lynch. He's the former manager of Fidelity. Big time investor, super successful investor. He says nobody has been right about market forecasting twice in a row. So we can all get lucky, but we can't do it all the time. And he says you can't do it twice in a row. John Bogle, he is Vanguard's founder. Vanguard is one of the largest investment firms out there. He says that stock market, after nearly 50 years of being in the business, he says, I don't know of anybody who's successfully and consistently done it. And he doesn't even know of anybody who knows of anybody who's done it successfully and consistently. And that's 50 years of business. That's saying quite a bit. And then CXO Advisory, they actually put analytics to it. And they tracked over 6,500 high-profile forecasts between 2005 and 2012. And they said that a coin flipper would have done a better job. Right? A coin flipper. So a 50-50 odds, you would have done a better job. So that's the facts. You have opinions, you got facts, and that's what we have right there. So the problem that we have is that most investors, they're just terrible at trading. The fact is, I think it's like 90%, 95% of all traders lose money. They end up buying high and selling low, all right? And I've talked about this before. It's our human psychology that prevents us from being successful. We're motivated by two things. We're motivated by moving towards pleasure and moving away from pain. So when the price was going from 8,000, 6,000, 5,000, 4,000, 3,000, it was painful. And people were selling and nobody wanted to buy, right? Everybody wanted to sell. And then of course, everyone's saying, well, it's gonna drop to 1,300 and 2,000, right? So nobody wants to buy, it's too painful. But as the price starts going up, now we've seen it go from 3,000, 4,000, 6,000, 8,000, it touched 9,000 today. Now everybody wants to buy. So we want to rush towards pleasure. We want to go away from pain. And that's just our normal instinct. That's our human psychology, which makes it very difficult for us to be good traders. So we end up buying high, selling low. We end up sitting on the sidelines on the best days. And so this is a big piece of it. So because of our human psychology, because we want to get out when it's painful, because you're selling when it's at $4,000 and $3,000, you end up sitting on the sidelines when it's the time that you should be in. But of course, we don't know this. When you look in hindsight at the chart, it's very easy to see, oh man, why didn't I just sell here and buy here and then sell here? It's very easy when you're looking backwards, but when you're in it, it's painful and you can't get it. So because of that, you get out you get out and then you miss the best days, all right? And not being in the market, that's what I'm talking about. When you've parked your money on the side, or you've capitulated altogether and you're out, and then you miss out on the returns that come back from that. Now, there's a solution for this, and there's a very, very easy way that anybody can do this against your own human psychology, and I'm gonna tell you at the end, so make sure you're staying tuned because you need to know what this is. I actually have facts and figures I'm gonna show you like I always do. All right, now, the history shows us that timing markets don't work, all right? Now, you can believe whatever you want, but I like to talk about facts, not opinions. So we can look at the investment data from the traditional markets. We don't have enough cryptocurrency data to really make a conclusive argument, but we can look at a lot. We can look at a long time of regular market data. And so if we look at like an investor that was fully invested, meaning all his money was in the market at the time, in the S&P 500, the biggest market, from 1995 to 2014, all right, so it's a 10-year run, they had about almost a 10% annualized return. So if they had all their money in from 1995 to 2015, I'm sorry, that's a 20-year return, they had about a 10% return. All right, now it's actually, I put 3,600 days, but I guess that was out of 10 years, so it's actually double that, so it's almost 8,000 days. So over 8,000 days, 10% return. However, out of those 8,000 days, if they sat out of the market for the 20 best, their returns dropped from 10% down to 3.6, right? They got about a third of the gains just by sitting out of the market almost 8,000 days, just 20 days. And if they missed 40 days out of 8,000, they lost money. Amazing, right? So just missing out on those best days. Now, I don't have up on the screen, but as you might guess, or almost ironically, the best days always follow the worst days. So as soon as you're getting out, boom, the market rebounds, but you were out. You didn't have a chance to get back in, all right? This is facts, all right? Out of almost 8,000 days, if you missed the best 40, you lost money, went from making 10% to losing 40. Now, cryptocurrency makes it even more difficult because it's volatile. Crypto is super volatile. If you're in the market, you know what I'm talking about. Now, if you've been in the market for any amount of time, we look at 10% swings like nothing. So the market did 10%. We're like 10%. We see 10, 20% a day. We don't even care about that, right? Cryptocurrency is volatile. If you know what I'm talking about, give me some thumbs up on this, right? If you're a survivor, if you've made it through, if you've been in the markets, you know what I'm talking about. So give me some thumbs up. All right. But the cryptocurrency is volatile. So what are we going to do about it? That's what we want to know. Should we buy now or should we wait? Let me tell you how to think about this. I'm gonna tell you how to figure this out. So there's really two ways that you can go about investing, all right? Just two ways, I'm gonna make it simple. The first one is LSI, all right? We call that lump sum investing. And basically what I do is I take all my money and I throw it in. It's a lump sum, boom, put it in, I put it all in at one time. All right, the other way that we can do it, you've probably heard of DCA. DCA stands for dollar cost averaging. And with dollar cost averaging, what we want to do is we want to take our total allocation, but instead of throwing it in one lump sum, we're going to put it in over a period of time. The whole allocation, but over a period of time. So it's DCA. And I'm going to show you what both of those are. We're going to look at some data and some facts, all right? So there's Vanguard. I referenced Vanguard earlier. They're one of the largest investment firms out there. Very, very credible. They went back and they did these reports and they showed that from 1802 to 2015, we're talking a long time here. They looked at all the markets from that whole period. They looked at monthly and yearly returns, and they looked at different 10-year periods. And over these different 10-year periods, they ended up with mixed results. I know that's not what you wanted to hear, but they ended up with mixed results, and that's because there was a lot of different periods in there. So for example, if you would have done a lump sum investment at the peak of the Great Depression, you would have lost money during that 10-year period. If you would have tried that during the 70s recession, it would have been bad, right, during that 10-year period. However, when the markets are running up pretty good, outside of those kind of depressionary years, dollar cost averaging didn't work so good. And so it depends, all right? There was mixed results, but I'm not gonna leave you with that, don't worry. So what are you gonna do about it? Where are we at right now? Is Bitcoin going to drop back down to 3,000, to 6,000, or is it going to run from here? Now, we do know that the market's gonna pull back. It always does, right? Nothing goes up in a straight line. It's like 2 steps forward, 1 step back, 2 steps forward, 1 step back. And right now, the market is continuing to make higher highs, but higher lows. So that's what's really cool. And that's what we want to see in an uptrending market. We want to see each time it pulls back and goes back to a low, it's a higher low than what the previous low. That's what I'm talking about. Now, we don't know when that is. Could Bitcoin go to 14,000 and then pull back to 10? Sure. Could it pull back from 9 today and drop down to 6? Sure, we don't know. But if you're waiting for 6, you may never get that chance. So the question is, are you better than a coin flipper? Do you trust the people on Twitter, on YouTube that you're trusting, or do you want to go the safe route? So I'm going to show you how to do either way. So the first way is to start here, right? So the first thing you have to do, and this is what I pound the table on if you've been watching my videos for any amount of time, then you probably already know. The thing that I pound the table on the most is asset allocation, because I lost all my money. I lost over $25 million in real estate because I didn't understand this one core principle. And I want you to make sure you do that. So asset allocation. So you want to take all your investable assets, all the money you have to invest, all right, and then you want to divide that up and put them into different assets. All right, so put some into stocks and put some into gold and put some into real estate and put some into cryptocurrencies. Come up with that asset allocation. Now, I have a guide that walks you through this. I wasn't planning on it, but I'll link to it at the end. So you can download my asset allocation guide, which will teach you how to do this, all right? Perfect time. So I'll link to that at the end, so stay tuned. I'll put it in the link down below as well. All right, now take the percentage. So now out of all my investable assets, let's say I'm gonna take 10% or 20% and put that into crypto. And then of what I want to put into crypto, 50% will be in trading and 50% will be investing. Okay, so now I have what I want to invest, right? So I've chopped that down. Then what I want to do is of that, how much do I want to put in each position? All right, so I'm going to put 30% into Bitcoin and 10% into Ethereum, and I'm going to spread the rest around other alts or whatever it is that you decide. All right, and the guide's going to walk you through to figure that out. All right, then once we have those numbers, then we can either do the LSI or the DCA. Now the LSI, right, like I said, is the lump sum investing. And basically what you're trying to do is you're trying to wait until you find the right time. So that's the goal. So is it the right time right now? Have you done your own analysis? Have you looked at the fundamentals? Have you watched the video why I showed you why I thought Bitcoin was undervalued? Have you done more of your own DYOR, do your own research, etc. So wait until you find the right time. If you think the market's gonna drop, then wait. If you feel good about that, and then what you're going to do is wait till it drops some more, and then you're just going to put it in. All right. The pros and cons to this are a couple things. One, the pro is if you get it right, you're going to get a better entry, and you're going to make more money in the short term. Well, you make more money overall. So the pro is if you do get it right, you're going to make more money. The con is that if you get it wrong, you're not going to make as much money. It's also going to cause you a lot more stress. All right, it's going to take a lot more time. You're going to have to be watching this thing like crazy. So those are the pros and cons. Maybe you make more money. Maybe you don't make as much money. Maybe you end up way more stressed, or maybe you take it easy. So those are the difference. That's the LSI. If you feel good about picking, then hold and wait. Now, lump sum investing. Let's take a look at this. All right, I'm going to break down the numbers. All right, these are the facts. So if you look back since October of 2017, so that's 87 weeks ago. All right, so if I would have put all my money in a lump sum in October of 2017, 87 weeks ago, the price of Bitcoin was below $5,000. It was $5,011 back then. All right, that means if I would have put all my money in back then, I would have a return today of 42.5%. All right, now it's pretty good, 42.5%, but I would have had to put it in way back then. Now, if I would have put it in December or January or February or March, etc., I would be negative. I'd be negative, all right? So you would have had to find the right time. Now, you would have had to buy Bitcoin under $5,000 to today have a profit of 42%. So over that 87 week period, you had 18 weeks where you could have bought Bitcoin for less than $5,000. So since October of 2017 till today, 87 weeks, there was 18 of those 87 weeks you could have bought it. So if you were really good, you bought it during one of those windows. If you didn't, then you haven't made 42%. Now, why do I pick 42%? Because I want to show you what dollar cost averaging has done. Now, to even make it more unfair, to prove my example, well, before I get to the facts, I'll tell you. So dollar cost averaging, like I said, is you're going to start buying right now, just like you do with the lump sum, right? You'll start buying right now, but instead of putting it all in today, I'm going to average it into positions over time. All right. The pros and cons to this are, the pros are that if Bitcoin price goes down or up, I'm going to continue to add into that. The pro is that I don't have to be stressed out. I can put this onto autopilot and I can set up an auto buy, and just once a week or every 2 weeks or once a month, it just automatically buys. It's hands off and it's a system. And I don't have to worry about it. I don't have to stress about it. I don't have to worry about if Bitcoin price is going to go up or down. And I just let it do its thing, all right? The con is that if the price starts running away from me right now, I'll end up paying more for it. So if I lump sum in today at 9,000, I'm locked in at 9. And if it goes to 12 and 14 and 18, well, I'm locked in at 9, I'm looking pretty good. If I'm averaging in, then I have to buy it at 9 and 10 and 11 and 12 and 15. So my average price is gonna be higher. So that's the con. However, let's see what that looks like. Now, I put this slide up on the screen just real quick for those people that maybe still aren't quite getting what dollar cost averaging is. And this kind of is a real quick example here. So just take a look at that. If you want to go back, just rewind it and pause it. I'm not going to go through that for you. Try not to keep you too long. But let's look at dollar cost averaging, because this is pretty cool. Now, to make it more unfair, to even prove my point, instead of going back to October, I'm gonna say if we started buying in December, at the very peak of the market, at Bitcoin's highest price, in December of 2017, that was 80 weeks ago, the purchase price, you would have started buying weekly at $19,870. That was the peak of Bitcoin. So I bought at the peak, at the very top. I bought at the worst possible time you could ever buy, the very peak, 19,000. I bought it there, but what I did is I bought every single week. So since that day, I've bought every single week until today. All right, so I've bought for 80 weeks, and just it goes out of my paycheck, and it's $50 a week or $100 a week or whatever amount, doesn't matter. Today, I would be on 42.5% return. So even though I bought at 19 and 18 and 17 and 16 and 15 and 14 and 13 and 12, even though I bought all those high prices, I'm still up over 42%. Now let me put that into perspective for you, all right? 42%. Last year, if you would have been in the stock market for the whole year, you would have lost money. This year, you're up about 15%. So you would have made 15%. You would have lost money last year, up 15% this year. If you would have started buying Bitcoin at its peak at the worst possible time and just bought every single week, you'd be up over 42%. We're talking like triple what the stock market has done this week. So that's amazing. It's amazing. Now, the dollar cost average window, what's cool about this is, like I said, on the lump sum, out of 87 weeks, you only had about a window of about 18 weeks. But with dollar cost averaging, you just buy every single week. It's the most mindless, brainless thing you can do. Just put your auto pay on and boom, it just goes out. So that's the power, that's the facts. Now, the one thing we always need to look at, is it the right time to lump sum in or dollar cost average in? You have to think about time frame. And the thing with time frame is that over a long enough period of time, both strategies work. And so when I go back to that study from 1800 to 2015, they looked at all these 10-year periods, and different 10-year periods worked out different. Sometimes DCA was best, sometimes LSI was best. But that was over a 10-year period. When you looked over 20 years or 30 years, it didn't matter. They were both doing really good. And that's because overall, even though the market was going down, it would always go back higher, down, higher, down, higher. And I believe that the Bitcoin and the cryptocurrency market will do the same thing. So will we see another 30% pullback? Definitely. We'll probably see a bunch of them. Will we see another 80% pullback? We probably will. But over a long enough period of time, the market is going to continue to go higher and higher and higher. So either strategy will probably work. If you believe, like I do, that Bitcoin could easily get to $50,000 in the next several years, then does it really matter if you buy at 9,000 or try and get back in at 6,000? At 50,000, it's not really going to matter. So over a long enough period of time, it won't really matter. All right. Now, the most important things, I have to pound the table on this. The most important thing is to remember to never over invest. All right. And that goes back to what I said in the beginning about this asset allocation. So deciding upfront what percentage of your assets do you want to put into crypto? What do you want to invest? What do you want to put into position? So if you're saying, I'm going to put some into my paycheck every single week, that's fine. But decide upfront how much you're going to put in. So I'm going to put in whatever, $1,000. And I'm going to put in $10 a week until I get to that $1,000. So you're not just going to put in $10 a week forever. No, you want to say, I'm only going to put in 1,000 max, and it's going to be $10 a week, all right? So decide that up front. All right, now, just real quick, I want to say, give me some thumbs up if you're liking this. If you don't like it, give me some thumbs down. Either way, I want to hear from you, and I love to have your comments down below. I respond to all of them. And if you're not already subscribed to the channel, please hit the bell, subscribe, and get the notifications turned on. Now, like I said, don't overinvest. Choose how much you're going to invest from the beginning. Pick a strategy and stick to it, right? Find one that works for you, one that matches your time commitment, your level of commitment, of confidence, and stick to it, all right? Remember that over a long enough time period, it's all gonna work out. So if you're just trying to get in for a quick pop, and that's what traders do, right? Traders are like, hey, I'm just gonna buy it here and sell it here, and I want that to happen in a short period of time. But as an investor, think about having a long enough time frame, and then always remember that you need to diversify into other assets, all right? Like I said, don't just buy crypto, don't just buy stocks, don't just buy gold, buy everything. Diversify into all those assets, all right? Now, again, give me a thumbs up if you like it. If you don't, give me a thumbs down. Let me know. That's all I got for you today. Hopefully that makes sense. Good luck with your buying, timing it, or averaging in. Leave me a comment down below. Let me know which strategy you think works the best for you. Just say LSI or DCA. I want to know which one is it going to be for you. And that's it. To your success. I'm out.